What is going on, guys? In today's video, I am going to teach you what a stop loss is, how to use a stop loss, where to place stop losses, and the significance of them in your trading. I'm a professional trader and I made over $2,500 today using these same stop loss principles. Stop losses are a critical part of risk management. And this is something that a lot of traders, a lot of gurus, they don't really talk about. They talk about making money. They talk about getting, A plus home run setups, but they don't talk about the risk management side of trading. And frankly, there are way too many traders out there that just ignore stop losses or avoid placing them in the first place. For you guys to practice solid risk management, you need to use stop losses. And what a stop loss is basically once you enter a trade, you need to place a stop loss at a particular price. So once the trade, or if the trade doesn't go in your favor, it could hit that stop loss price and exit you out of the position, preventing any extreme or additional losses. So a stop loss is kind of like a safety measure for the trade. So in case the trade doesn't go in your favor, you're not going to end up losing a ton of money. But it's really important to know exactly where to place stop losses and the mechanics of them. So let's get right into the class. So for this class, we're going to be discussing two very basic setups. There are way too many traders out there that have, 16 different strategies, 15 different chart patterns. I keep my trading simple. And for today's video, we're going to be going over the two main strategies that exist in trading. But before that, let's take a look at how much money I made today. I made $2,530, mostly from FL, QRTEA, Grab, SOND, and TUP. And I used these exact stop loss principles for these trades. And if you guys actually want to trade with me, join my private community and join my coaching sessions that I host every single day, make sure you click below. You're going to be put in my private room and you'll be able to discuss trades with me. And you'll be able to see the exact stocks that I'm watching every single morning going into the stock market open at 9:30 a.m. Eastern. So I'll see you there. But let's continue on with the presentation. So these two basic setups that we're going to be reviewing is the base breakout and the buy setup / pullback pattern. So with the base breakout, we have a rally and then we have a consolidation at the highs. When it comes to a buy setup, this is basically a pullback pattern where you get a rally, right? Then we get a pullback and we want to play the pullback. A lot of people refer to this as buying the dip. However, there's buying the dip the amateur way, and there's the buying the dip the professional way. My intention is to show you how to do it the professional way. But ultimately, these are the two ways that stocks correct themselves, right? They correct themselves either through time, through a consolidation, or through price action or a pullback before we make that move higher, okay? So what are our entries and what are our stop losses for these two setups? So for the base breakout, our stop loss is going to go directly below the base. So if you're playing a base breakout, just know always place your stop loss below the base. The entry is going to be above the base. So super simple, entry above the base, stop loss below the base. Meaning if price hits your entry and then drops to your stop loss, you exit at this price below the base. When it comes to a buy setup, right, or the pullback pattern, your entry is going to be over this entry bar that we have here, kind of the lows of the pullback. And the stop loss is going to be put right here, directly under the lows of this candlestick, which is the entry bar. So with a pullback pattern, just remember your stop loss is going to go at the lows of the pullback. And of course, we get these subsequent moves higher, and this is what we're going for. With the breakout and the buy setup, we're going for a nice entry here. We place our stop loss below the base, nice rally. Place our entry over this candlestick, stop loss under the pullback, nice rally. Now, let's talk a little bit about the mechanics of a stop loss. And it's important to know how to calculate the size of a stop loss. So the size of a stop loss is the entry price minus the stop loss price. And that is the size of the stop. So in this case, let's say we have a base breakout, right? We have a rally base. Our entry is above the base, stop loss below the base. So our entry, let's say, is $10. Our stop loss price is at $8, meaning if this hits our entry and drops to our stop loss, this is where we exit. So $10 minus $8 equals $2. That is the size of our stop. So when I say size of stop, just remember it's entry price minus stop loss price. So that's the size of our stop. Now let's talk about share sizing. Your stop loss, or the size of your stop, is going to heavily impact the amount of shares that you're going to be purchasing for the position. So for this example, let's say we have $100 risk, and we're going to be using the share sizing formula, which is risk, the dollar amount, divided by the size of the stop. Remember, we calculated that the size of our stop in this scenario is $2. Our risk in this scenario, let's say, is $100. And what I mean by risk is this is the maximum amount that I've decided I am willing to lose for this trade. And what I mean by risk is this is the maximum amount I am willing to lose for this trade. Meaning, if I get into the trade and it hits my stop loss, the worst case scenario is I lose the $100. This is a predetermined amount that I set and that you should be setting as well. So the risk, let's say, is $100 divided by the size of the stop, which is $2. 100 divided by 2, that is 50. That is the amount of shares that we could purchase to ensure that if price hits our stop loss after we enter it, we're only going to lose $100, which is our initial risk. So it's really important to know the share sizing formula and to apply it before you enter any single trade. Now let's go a little bit deeper and see how the size of our stop affects our risk to reward and our share sizing. So let's paint two examples here. We have setup 1 and setup 2. In setup 1, our entry is at $3. In setup 2, our entry is at $3. However, in setup 1, our stop loss is at $290, directly below the base. In this case, in setup 2, our stop loss is at $250. Okay, so let's calculate the size of our stop. Okay, so we know our entry is at $3. Our stop loss is at $290. Our stop size is 10 cents. So if we're risking $100 per trade with a 10-cent stop, according to the share sizing formula, we're going to be able to get 1,000 shares, right? Because $100 risk divided by the size of our stop, which is the entry price minus the stop loss price, which is 10 cents. 100 divided by 10 cents equals 1,000 shares. 1,000 shares is the amount that we can purchase to ensure that we only lose $100 if price does hit our stop loss. In this case, our entry is at $3. However, our stop loss is at $250, making the size of our stop 50 cents. You could see that it's way bigger than this stop, right? This one's 50 cents, this one's only 10 cents. So if we're risking $100 per trade, $100 divided by the size of our stop, which is 50 cents, equals 200 shares. Meaning if price hits our entry at $3 and then drops to the stop loss price at $250 with 200 shares, we're only going to lose $100, which is our predetermined risk. At the end of the day, we have to ensure that we are only losing our predetermined risk, which in this case is $100. For your case, you should think about what you're comfortable with losing and then make sure you are risking that same amount for every single trade that you take. Doesn't matter whether you think this setup is more likely to work versus another setup, you should be risking the exact same amount per trade. In this case, it's $100. For you, it could be less. If you're a beginner, I recommend $50 to $20 to even $10, especially if you're just starting. If you're experienced, personally, I do anywhere between $300 to $400 risk per trade. As you get more experience, you can raise your risk. However, you have to be risking the same amount per trade. And that's why it's so important to apply the share sizing formula and to be aware of the size of your stop, because that, influences your risk. So we have these two scenarios, right? We have one with a 10-cent stop and another with a 50-cent stop. Now let's kind of look at the ramifications of this. Let's say for both of these examples, our target is at $4, right? Setup 1, $4, setup 2, $4. If target is reached, right, because we entered at $3, if it reaches $4, we're going to make $1 per share that we have, right? Because if it increases from 3 to 4, That's $1. So we're going to make $1 per share. Remember, we were able to buy 1,000 shares with setup 1, meaning we're going to make $1,000, right? Because it's $1 per share. We have 1,000 shares, $1,000. However, for setup 2, it's still going to hit the same target at $4. We're going to make $1 per share. However, remember, during setup 2, we only were able to buy 200 shares because the size of our stop was larger than setup 1's. So because we have a larger stop loss, in this case, right, since we only bought 200 shares, $1 per share for 200 shares, that's $200. So as you can see, we're making way more on setup 1. We're making literally 5 times more on setup 1 because we have a tighter stop loss, right? Here, our stop loss, the size of it is only 10 cents. Here, it's 50 cents. And as a result, once the trade hits our target, we're making way more on the setup that has a tighter stop loss compared to the setup that has a wider stop loss. So what does this mean? And what this means is the tighter the base, right, since it's a base breakout, but in other words, the tighter the stop loss, the better the reward to risk. The tighter the stop loss, the better reward to risk, as you can clearly see, okay? So we should always be looking for setups that have a tight stop loss. We don't want to see sloppy setups that have a huge stop, a huge entry, a lot of distance between the entry and the stop loss price. We want to look for tight consolidations and tight patterns because they have tight stop losses, which means we can make more money with the same risk. We're not risking more on this trade. We're risking $100 on this trade and $100 on this trade, but we can make 5 times more on setup 1 because we have a tighter stop loss, okay? Now let's look at a few examples of real charts to see where I would be placing my stop loss and whether we have a tight or a loose stop. So the first setup we're going to look at, this is actually a setup that I played a couple weeks ago. And as you can see, we have a drop. And what's the setup here? We have a consolidation or a base breakdown. So all of this applies for short setups as well. So if it's a breakout, the same thing applies for a breakdown. In this case, we have a breakdown. So we have a drop stemming from the 20-day moving average. Now we have a consolidation into this declining 20-day moving average. This is a textbook base breakdown. So I'm going to be entering under the base right here, and I'm going to be placing my stop loss either here, which is over the base, or even here. If I want a tighter stop loss, I can place it here, but the safer alternative is to place it over the base, over this kind of topping tail that we have right here. And as you can see, this is amazing reward to risk. You can see how tight the stop loss is compared to the drop that we had. So with something like this, since it's such a tight base, such a tight stop loss, we can get more shares, right? As we clearly examined in the previous example. So this is an excellent reward to risk setup. Let's move on to another example. And here we actually have a few different types of setups. The first setup that we have is a buy setup right here, which is a pullback pattern, right? We have a rally higher, we have a retracement. It's not a perfect pattern. However, it's still a buy setup pullback pattern. So in this case, our entry would be over this candlestick. Our stop loss would be under this candlestick. Okay, so stop loss goes under the lows of the pullback. So right here would be our stop loss. Right here would be our entry. And boom, what a nice move here, right? And you could probably tell the reward to risk is excellent, right? This might have been a 20 to 30 cent stop or something like that. And this probably went up easily 60 to 90 cents, earning a 3-to-1 reward to risk. All of a sudden, after that, we retrace, and then we start basing into the trending 20-day moving average. And here we have a breakout. Our entry would be over the base, probably like over here somewhere, or perhaps over here. Stop loss would be under the base right here. So this is where we place our stop loss. This is where we place our entry. Decent stop loss. We have, it's not extremely tight of a base. However, it's still pretty good reward to risk considering the move that happened after, right? So stop loss here, entry here, nice move higher. What did we have after that? We have a buy setup or a pullback pattern. where we rally, then we start to retrace. We get some nice entry bars. And entry is going to be over these bars right here. Stop loss is going to be under the lows of the pullback right here, right into the trending and rising 20-day moving average. That's exactly what we want to see. And boom, we had a pretty nice rally and really nice reward to risk. You can see here the size of our stop here is probably 15, 20 cents. And this produced a 30 to 40 cent move. That's 2 to 1 or 3 to 1 reward to risk, which is what we look for. Moving on to the next setup. Here we have a buy setup where we have a huge rally higher, then kind of a pullback, sets up as a pullback here. Our entry would be over the base, stop loss right, or entry would be over this bar, stop loss would be right under the pullback right here, and really nice move higher, nice reward to risk as well. And the last setup that I want to do is lift, and this is a breakdown right here. So we have a drop after a huge gap on the daily charts, right? I think this is the 5-minute, but there's a huge gap on the daily. You can see the gap is right here. And I really like to trade gaps because they provide momentum and they provide volatility for a stock. So I exclusively trade gaps during the trading day. And if you guys want to learn more about gaps and you want to see exactly how I create my personal watch list every single morning heading into the open, make sure you click the link below, join my private room. You can join my coaching sessions and you'll be able to see exactly how I create my gaps list heading into the market open every single day. So this was one of the stocks on the gap list. And this was a base right here. We have a really nice topping tail. I call this a shakeout candle. So in other words, the buyers came in, they tried to bring the stock higher, but then the sellers were like, no, 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 you're not going to do that. And they brought price all the way back down. That's why there's a huge topping tail. I always teach my students, if you see a topping tail, it means that the sellers have taken control. And then it started to base, really nice base breakdown. So entry would be under this base right here. Stop loss would be directly over the base or over this candle. Personally, I chose to put it right over this base and entry right under it, and really nice follow through. And I took profits somewhere around here, okay? So I hope this all makes sense. I hope you guys can understand the effects that the size of your stop loss has on your trade and on your reward to risk. And you really have to understand that for these two basic setups, the pullback pattern and the base breakout, that you should be placing your stop loss either below the base on the base breakout or below the lows of the pullback if it's a buy setup. So make sure you stick to your stop loss. And at the end of the day, it all comes down to discipline. You have to stick to your stop losses. You have to share size accordingly. I'm showing you guys exactly how to do that math to make sure you purchase the exact amount of shares to ensure that you're not losing more than your predetermined risk. And a lot of traders don't really talk about this. A lot of traders talk about making money. I'm making thousands per day. That's great. But how much are you losing, right? How much are you losing on your losing trades? What about your bad days? How much are you losing on those? And the best traders in the markets, the ones who make the most, are the ones who lose the least. And that was the first skill that I adopted in the markets, is to make sure I don't have any losing days. The only way to not have losing days and to, not have huge losing trades is to follow your stop loss, share size accordingly, and go for trades that have a high reward to risk, or in other words, a tight stop loss. I hope this video helps you out. I hope you guys have some insight on how to set your stop losses and how to follow them as well. I'll see you guys on the next video. Thank you for watching. And if you can, click the like button, click the subscribe button, and I'll see you guys in the next video.